Welcome, everyone. My name is Bill Fox, and we have another session of Beyond the Noise. Our goal at the Fox Alliance is to offer insight into big economic themes. Our topic for today is a good one. Is the demise of the US dollar upon us? For me, it's been one of the most asked questions from my clients. Today, we'll be discussing what is a reserve currency? How did the dollar become the world currency? What has happened since Nixon got the US off the gold standard? Who are the viable alternatives to the dollar? What is the bottom line and what does it all mean? Our panelists will be speaking for about 30 minutes and we'll have time for some questions after that. We will not be able to take questions from our chat feature, but if you'd like to ask questions, just email me, bill@thefoxalliance.com. Our presenters today will be Max Clark and Laura Cooper. Both are wealth advisors with our firm, the Fox Alliance. The third presenter will be Josh Renfro, and he's our managing partner. Max will be leading it off. Max, take it away.
Thanks, Bill. I appreciate it. As we get started, I think probably the best place for us to begin would be answering the question, what is a reserve currency? Since the big question is the U.S. going to continue to be that reserve currency? I think it'd be good for us to get a good definition of what that means. So on the screen is how we would define it, and it's a reserve currency is a large quantity of currency maintained by central banks of various countries and other major institutions to prepare for investments, transactions, basically anything having to do with international trade. And another key component of this is that a large percentage of commodities globally, think oil, gold, all those sorts of things, are priced in the reserve currency. And as a result, other countries have to hold on to that currency in order to pay for those goods. So use this as kind of the foundation as we go into describing how we've gotten to where we are today and what the future likely holds. Let's begin the conversation by looking at the journey the dollar has taken to its dominance. And we have to go all the way back to really the end of the Second World War in order to answer the question, how did the dollar rise to dominance? Take a look at World War II's aftermath. And after World War II, the US was really the only country that could consume on a global scale. Look at these numbers. They're really surprising. At war's end, the US accounted for 50% of global GDP. So of all the production in the world, the US accounted for half of that. Pretty astounding. They also held 80% of the world's hard currency reserves. So think currency and more specifically, gold and silver. And as a result of this, you can really see the expansion of the US's production post-World War II. So in 1940, kind of right near the beginning of the war, gross national product was $200 billion. 10 years later, we'd increased that by 50%. 10 years after that, we'd increased it by another 2/3. So we saw a huge expansion following World War II's aftermath. And because of this strength, this strong position that the United States was in following World War II, that led to really the Allied countries getting together in Bretton Woods to formalize the US's strength in the world economy. So you guys have probably heard of the Bretton Woods Conference, and this formalization that occurred here at Bretton Woods is really what it's the outworking of the US's strength, but it really cemented the US's position as the world reserve currency. So we had 730 delegates from all 44 allied nations. They got together in 43, 44. Really near the end of the war, it became clear that the allies were going to win. And together at this conference, they were seeking to essentially establish the rules and regulations and a system by which the global economy would operate post-World War II. Two major things occurred which catapulted the U.S. Into world reserve currency status. The first is that foreign currencies many of them, were required to peg their exchange rate to the US dollar. And the second is that the US dollar was convertible to gold at request. So it was $35 per troy ounce of fine gold. And if we take a look at some of the quotes that would kind of explain the implications of this, the US Treasury stated that under the Bretton Woods system, the dollar was pegged to gold and most other currencies were pegged to the dollar. And as a result of this arrangement, dollars were used as the main intervention currency and hence reserve currency going forward. Why would other countries be willing to do this? What was kind of the main driving factor? I mean, we had 44 allied countries get together, and almost all of them, with the exception of probably the Soviet Union, agreed to have the dollar in the United States take this leading role, essentially, in the global economy. And the primary reason is that the U.S. was one of the few allied countries that had not had major physical damage and a just depleted economy following the war. And these, especially European allies, really needed the U.S. to spend money in their countries in order to help them rebuild. So this was good for everybody because the U.S. obviously was in a position of strength, and those that were recovering from the World War really needed the U.S. to spend money in their countries in order to help them rebuild. Prominent economic historian Barry Eichengreen, commented on the Bretton Woods system and explained that its success was primarily due to three factors. First, low international capital mobility. So the real implications for that is that a lot of the other countries had really been effectively destroyed. There was tight financial regulation. And the third, I think the most important here, is the dominant economic and financial position of the United States and the dollar. So that really speaks to how the U.S. rose to world reserve currency status or dominance around the world. So that begs the question, how do we get to where we are today, where we're having this conversation? Is the U.S. At risk of not retaining that dominance, of not continuing as the world reserve currency? And I think it's important for us to get more clarity on this by looking at the journey to today. And I'm going to turn it over to Laura, who will take it from here to break that down for us. Laura, take it away.
Awesome. Thank you so much, Max. So I'm actually going to begin at the end of the gold standard. Great. So in 1971, Richard Nixon removed the US dollar from the gold standard, creating the US dollar as a fiat currency. Now, one of the biggest questions is why? As Max just mentioned, all of the great reasons why you'd want to be tied to gold as the standard reserve. And there's a couple of reasons. One is the fact that the United States wrote more checks than it had in gold reserves. And so as countries came to collect their gold, turn in their checks for gold, we didn't have enough gold for the checks that we had written. And so we had to remove ourselves from the gold standard or default our currency. So that's one of the biggest reasons why the gold standard ended in 1971. Now, this could have been awful for the valuation of the US dollar. Josh is going to talk about this a little bit, but one of the most important pieces of a currency is the stability of that currency. If you want to maintain stability, why would you remove it, remove the thing that makes it stable? But as Max also mentioned, because the US dollar had really been the de facto world currency, world reserve currency due to globalization, it allowed for the valuation of the dollar to remain strong. So globalization has really led the charge from the 1940s really into the mid 2000s when it came to the strength and the high valuation of the US dollar. But what we've seen over the last 20 years is a rise of populism and nationalism and other factors as well that have really led to a deglobalizing force over the entire globe. So looking at populism and nationalism first, we've really seen this as a trend, not just in the United States, but globally. If you think about some of the larger elections we've seen over the last 10 years, we had the election of Donald Trump here in the United States. In Brazil, we've seen in the UK, the election of Boris Johnson, even in Israel, the election of Benjamin Netanyahu. really very unapologetically nationalist candidates who got elected and then started to enact policies in their country to really bring that deglobalization factor to reality. And so in the US in 2018, we had high tariffs, we had a trade war with China, we saw Brexit, where the UK left the European Union. And so this is a trend that has led to one of the largest efforts to deglobalize in our lifetime. But then we also had COVID-19, which really showed the fragility of global supply chains. And prior to COVID-19, there was a priority of low-cost manufacturing at all cost, meaning that it doesn't really matter where it's manufactured, as long as it's as low as it could be as far as cost, that ends up being a low cost to the end consumer. But after COVID, we saw that that wasn't really a viable option anymore. If you don't even have the ability to get that supply to the end user, the cost of manufacturing doesn't really matter. And so we've really seen more of a maintain supply at all cost measures instead. And I want to kind of sidestep and talk about why this is important on a grand scale. We have been so happy to export cheap labor and cheap cost of goods to countries like China for the last decade. And that's really allowed for innovation in United States companies to then have better priced products to the end American consumer. But if we see a major onshoring of production and manufacturing, that can really change the end price of the product to the American consumer, because as we know, Americans require a much higher wage, a much higher standard of work. And that all has costs implemented into the creation of the product that then gets passed to the end consumer. So one of the biggest conversations we've had over the last 12 months is about inflation. Is this more of a temporary problem? Is the Fed going to be able to maintain this in the short run? But really, I think in the long run, some of these major trends of onshoring and increased cost of production and manufacturing and deglobalization can have a much more long-term effect on inflation than anything we've seen today. So I just wanted to kind of make that connection. And then moving on to where we are in the last 18 months with the Russia and Ukraine crisis. So after Russia invaded Ukraine, that put the country of the world into three different camps. The first being the pro-Ukrainian anti-Russian camp led by the US and Western Europe. About 78% of the world's countries fall into that camp. Then you have the pro-Russian anti-Ukrainian camp, 3% of the world, really led by Belarus and Syria. And then we have the messy middle that I call, which is really led by India and China, almost 20% of the world's countries who are agnostic or indifferent to either side. This is a pretty interesting trend because typically in world wars or in global crises, most countries pick a side. They pick one side or the other. If you see Switzerland, the Swiss flag here, the Swiss are notoriously have been neutral for almost a century. We haven't really seen a major crisis where we've seen this many countries fall in that neutral middle. And now for countries like India, there's a resource piece here. 40% of India's oil comes from Russia, where the United States only 3% comes from Russia. So India has a little bit of a dependence on Russia, but this is an interesting trend of this neutrality where you would expect these countries to maybe pick a side, but they haven't. And the last thing I'll mention here as well is that this is just the number of countries. India and China hold 1/3 of the world's population. And whereas not every person in that country is going to agree necessarily with the leaders of that country, it still is an interesting statistic. And so the last thing here that I'll mention, and hands down the most important as we talk about this deglobalization effort, and especially how the US dollar has been affected by that, was the international response to Russia invading Ukraine. So the SWIFT system is an international banking system that allows individuals from different countries to transact, much like an exchange. And when Russia invaded Ukraine, the United States led an effort to kick Russia off the SWIFT system, virtually weaponizing the dollar. And that action froze $400 to $600 billion of Russian assets and gold that were dollar denominated. This is huge because we as a country, have made an effort not to send troops to Ukraine and fight on the front lines and not get directly involved in the war. But what we did do is say, we're going to weaponize the one thing that's probably the most important thing to you as you go into a very expensive war, and that's your money. And so if we can hit you in your wallet, we can really hit you where it hurts. And what this really shows the rest of the international community is that if you have reserves denominated in US dollars and you do something that maybe the US doesn't like, you don't actually have reserves in US dollars because the US can cut off the access to those reserves and you don't have money. So it disincentivizes those countries to hold significant amounts of US reserves over the long term, especially countries like China, who, like I've mentioned, we've had a deteriorating trade relationship with, deteriorating intelligence relationship with over the last 10 years. They're looking at this action and they're making note of it. And so I think this is really, really important as we lead into what happens next and who are the potential viable alternatives for a reserve currency. So with that, I will turn it over to Josh.
Thanks, Laura. So let's dive into this last area, which is really understanding in order for the US dollar to not be the reserve currency anymore or to be threatened in this way, there has to be an alternative because in global trade, you have to have an easy way by which different countries that have different currencies can choose to make exchange take place. And so the first question we have to ask when we're thinking through that is who are the viable alternatives that are out there? So there's a couple of things that we need to think about in terms of what would actually make for a good reserve currency. There's four major ones. I would argue this first one is probably the most significant, and that is the significant purchasing power. They have to be able to purchase a large amount of goods globally. This was one of the reasons why the US was a shoo-in for world reserve currency coming out of World War II. They represented 50% of all purchasing power. So there wasn't any country that came even close when it came to that. Positive global reputation, strong currency versus others, and then stable geopolitical climate. Those are our four categories that we really need to see to have a really good reserve currency. And so there really honestly are only 5 countries in the world that really have anything close to what it would take to become the world's reserve currency. And they really are represented in the BRICS countries: Brazil, Russia, India, China, South Africa. These are the nations, they've formed themselves an economic union. And some might even argue, well, why not consider using a basket of currencies instead of using one currency? And that's definitely something that's been discussed. But that is a much more challenging system to use, as those in the euro have ultimately ended up finding out. But anyways, these are the nations that we believe have the largest chance of potentially being a threat to the US's dominance as the world's reserve currency. So let's look at these individually one by one. First off, let's look at purchasing power. So you can see here the United States, by far the largest purchasing power, about 25.5 trillion, representing roughly a fourth of total global GDP or global purchasing power. China is reasonably close behind at about $18 trillion. But if you exclude China, notice that of the other BRICS countries, India, Russia, Brazil, these countries are less than 3.5% of global purchasing power. They really do not have enough to move the needle. Now, some might ask the question, well, Josh, you've got countries like Japan and Germany here who are over 4%. Why don't you guys consider them viable options to replace the U.S. as the global reserve currency? And the answer simply is they don't have a desire to. These countries are content with the current order. They are currently allies with the United States, and the current system has served them well. If you're going to have a country that actually will challenge the U.S. as the world reserve currency, it is likely to be one at minimum that is hostile to the U.S. or is at least indifferent to whether the U.S. is the leader or not. So let's move on to the next area, which is global reputation. So if we look at the 3 most likely options for potential global leader, India, China, and Russia, what you'll notice is that the favorability of India is reasonably good. But when you start to look at China and Russia, you begin to see that the favorability ratings go down pretty substantially. These countries do not have a good enough relationship with most of the major developed world where they could really begin to swing this from that side of things. And of course, that leads us to the third area, which is strength of currency. One of the things that people in finance have to realize is we have a concept of recency or adjacency bias. The thing that we experience most closely is the thing that we tend to think is happening everywhere. A great example of that, actually, that concept would be real estate. If you live in Austin, we've seen real estate prices go down 13 or 14%. And probably many people's natural assumption is that real estate prices across the country are dropping as well. And that's actually largely not been the case. Real estate prices have largely been flat across the rest of the country. But what we've experienced locally informs how we think of things nationally. In the same way, Americans here in the United States tends to look at our currency situation and then assume that everywhere else things must be much better. The reality, though, is that is actually not the case. If we look at this chart, which looks at the four major BRICS countries that could potentially be that global leader and looks at their currency in relation to the dollar, what you'll notice is that over the last, let's call it 9 years, we have seen the best currency amongst them devalue 15% worse than the dollar over that period of time, and the worst devalued over 75% more than the US dollar did over that same period of time. Many of these countries manipulate their currency. China is a great example of that. In fact, China in one day, I believe it was back in 2014, downgraded and increased currency to manipulate the price of their currency to drop 25% in one day. When you have countries that have currencies that are that unstable, especially in comparison to the US dollar, it makes it really hard to believe that the rest of the world would be willing to accept them as a reserve currency in those situations. So that leads us to the last area, which is political stability. And when we compare these 5 countries, the BRICS countries, what we see is that in a world of 193 countries, none of them even clear into the top 100 list, let alone the top 50 or 20, which is what you'd really want to see in a country that was going to be the world's reserve currency. So just kind of summarizing things, trying to get down to the bottom line. We believe that it's important to distinguish the world's reserve currency and really break it out into 2 separate facets. The first of which is the actual world reserve currency, where the predominant function of a world reserve currency is where you have governments, other governments, and you could also argue individuals choosing to store large amounts of their wealth in one single currency that the globe recognizes is a stable preserver of value. Japan, China, and many other nations hold a lot of US government bonds as a de facto savings account for their country. And so I think that's one side of it. The other side of it is trade currency dominance. Oftentimes these 2 things will go together, but they don't have to go together. And so I think it's important for us to distinguish those as we give our opinion on what we think is the likely option. So here's what we think is the most likely option. First, we believe that the US will likely remain the world's reserve currency for most countries. And I really want to emphasize that word, most countries. As Laura correctly pointed out, the United States' action in weaponizing the dollar in the Russia and Ukraine conflict has sent a very clear message to, first, governments of the world. If you choose to cross us and you have your reserves in the dollar or gold and we have control over it, we will use it against you. I cannot emphasize enough just how swift a departure from past foreign policy this has been. We've had fights and conflicts with people before, but have not ultimately used our dominance as the world reserve currency as a weapon in this sense. So I would be willing to bet a very hefty sum of money that Russia post this conflict, if they're able to get any of their reserves back, will not hold reserves in the US dollar or in institutions where the US can get their hands on them. Similarly, if you're a country like China, Saudi Arabia, others that do have conflicts at different levels with the United States, what incentive do you have to use the dollar as your international savings account. You don't, because the risk you run in is that if we're in a conflict and the US doesn't like what you're doing, they can at any point in time choose to weaponize the dollar and take away large amounts of your country's resources at a time where you might otherwise desperately need it. The move that we made was a very dangerous one. And so some people, most people actually, when they talk about the US not being the exclusive world reserve currency, almost universally what they reference is the large scale inflation that we've seen over the last 2 years. Our argument would be, while that is not helpful, by far the most important factor in this discussion has much more to do with the fact that we've chosen to weaponize the dollar as opposed to the inflation that we've seen in our country. Because in most of these cases, the other countries that could be used as alternatives have had as bad, if not worse, inflation than we have. Now, the other component that I would add to that is, in addition to us weaponizing the dollar, we also chose to seize the property of many Russian, actually most Russian oligarchs. And so that was the other message that was had, because the world reserve currency is not just about governments. It's also about wealthy individuals or companies. If you're an international company or an international businessman or woman, what currency are you going to hold if you have to hold some money for a longer period of time? Historically, that would have been the US dollar. That's why you have a lot of wealthy Chinese, and Asian and African and European businessmen and women who ultimately hold large amounts of property or stock portfolios inside the United States, because we have the rule of law. We protect our assets, and it doesn't matter your nation or creed. Everyone has the same rights under the law. But with the whole Russia invasion, and specifically the unlegal and unjust seizure of Russian oligarch assets, that also put that at threat. If you were a Chinese citizen, because what happened? Russia attacked Ukraine, so therefore we're going to seize Russians' property because they might be able to influence Putin. So if you're now a Chinese businessman or an Indian businessman or a Saudi businessman or woman, and you have property in the United States or assets in the US, you got to be asking yourself, if my country now has conflict with the US, will the US just decide to seize my assets? It takes away an entire reason why most of them are doing it. Most of them are choosing to have their money offshore because they're afraid of their country. They're afraid that they might lose everything and have to flee somewhere else. And so we've really put ourselves in a situation where not only have we put stress on countries that are hostile to us, but their citizenry, who otherwise might be friendly to us, are going to be less likely to use the dollar as their storage of value. So there's a couple of reasons that we do believe that for most countries of the world, the reserve currency will not change. We do think for those hostile / are likely to go into conflict, that many of those countries will start to shift away from the dollar when they can. But we do think that for most countries, that won't be the case. Why? Inertia. There's an existing system that's been in the world now for going on 85 years. And a lot of countries have built infrastructure and systems around that process. So inertia is on the side of it staying that way. The second, and probably one of the most important, is there's not a viable alternative, as we've already talked about, with the BRICS countries, which are probably the 4 or 5 leading ones that would have a chance to compete with the US in this area. They currently just aren't in a position to be a good, viable alternative. The US is still the world's largest economy. Once again, coming out of World War II, the United States was 50% of the economy. And while that number has still shrunk, we still represent 25% of all global consumption, which means we can dictate a lot with that kind of situation. And I've already touched on the fourth point. At the end of the day, I think this quote crystallizes our view quite well. In the kingdom of the blind, the one-eyed man is king. While the United States has its challenges, we still have inflation at relatively modest numbers compared to what the rest of the world has seen over the last couple of years. And as a result of that, we tend to think on the reserve currency status, we think most of the world is likely to continue to use the US as the world's reserve currency, which leads us to the second distinction, which is trade currency dominance. This is an area where we think that the US will likely see a fairly substantial decline. One of the reasons is that those countries that are hostile to the US or might come into conflict with the US do represent a fairly large amount of global purchasing power. And if they have the ability to strengthen their own currency, or an enemy of the United States, or at least another country that is not the United States, we think that many of them will choose to do so. Many countries have relied on SWIFT. And one distinction I will make is that we froze Russia's reserves. SWIFT is the system that allowed Russia to pay for different things that they needed. And so we literally cut them off from that system. That is not something that countries are going to forget. And so if they can find other ways to transact where it doesn't cost them and there's not a lot of risk, we believe that many of them will choose to do so. In fact, we've already seen many countries already start to conduct bilateral trade in either one of those countries' currencies as opposed to the US dollar. Still early, but we've started to see that on the rise much more, most notably recently with China and the Saudis with oil and gas purchases. But one important thing to distinguish here, though, is this. That only works in a situation where the one country doesn't trust the currency of the other if the trade balances are going to be relatively similar. So if China buys $200 billion of goods from the Saudis, but Saudis only buy $100 billion from China, that's going to be a problem. Because if China pays with 200 billion of renminbi to purchase Saudi goods, China now can spend that 100 billion on the goods they would need, but they also now have 100 billion extra renminbi that they can't spend, which means that if China manipulates the renminbi, it drops in value. The Saudis are now sitting on currency that isn't worth as much as it once was. So we do think that trade balances will limit how much of this bilateral trade in each individual country's currency can take place based on the particular trade relationship that exists there. Just kind of in summary, if we look at financial strength, there are 3 or 4 areas that we need to be thinking about. Global trade, our share of global GDP, the amount of payments that occur on the SWIFT system, the amount of foreign currency reserves, and lastly, the amount of foreign trade. And if we look at it in terms of dollars, global trade, the US represented roughly 9.3% in global trade today. That's down a little bit from what it was in 2012. But if you look at the other major metrics, the percentage of global GDP, that number has risen almost 4%. The biggest one has been the amount of SWIFT payments. SWIFT payments have risen almost to right at 46.5%, a 13% increase over the last 11 years. Foreign currency reserves, you basically holding the US dollar as a reserve by a country, that has come down. We think that number will continue to come down as countries like China choose to divest. But this is the area where we tend to think that we will see the biggest change, and that is in actual trade value. That's where we think we will see the largest change over the next 4 or 5 years as more and more countries try to transact in their own currency or the country they're trading with currency. With that, I'd like to wrap up with one final interesting topic that we've seen recently, and I think this is a really important point to make, which is last year, many of you remember the bond market had its worst market since 1842. You saw the Barclays aggregate at one point down 18 to 20%. And so this was a really challenging time for more conservative investors. But for many people, we really didn't see the full extent of that drop until we started to look at what was, in many cases, considered some of the most safe investments you could ever make, which was investing in long-term 30-year government bonds. If you had been someone who had invested in long-term US government bonds in 2020 or 2021, so bonds maturing in 2050 or 2051, those bonds today are trading at 45 to 47 cents on the dollar, which means that you would have experienced a 53 to a 55% drop in their value over the last 18 months. That makes that drop as bad as stocks during the great financial crisis in 2008. This is not a story that many people are talking about, and it's completely disrupting most financial models today. But it's something that we think is very relevant, because guess who the largest holder of US long-dated US government treasuries are? It's the Federal Reserve. They own 18% of them, and most of those bonds now are sitting on 50+% losses. Historically, when the central bank made money, guess what they did? They gave that money to the US Treasury. We got a chance to spend that money on US government programs. One of the crucial questions you have to ask is, in a year like this, the Federal Reserve doesn't have any income. They have a massive loss at this point. It's projected to be over $100 billion in bond losses. What do they do with that? Do they pass that loss on also to the US Treasury? We don't know. It's something we've never seen before, but it's something we will be watching closely. And so with that, we will be opening it up for questions.
Thanks, Josh. Thanks, everyone. All right, first question is, there is much noise about the digital dollar. Is it real or primarily a gold promotion? Josh, would you answer that one, please?
Sure. So there's been some discussion of using a digital dollar. Largely, though, it is meant for simply the ease of transacting and doing business. It is not because the U.S. has suddenly come to the conviction that that gold should back everything. At this point, it is not expected that it will be gold backed, and so it has been used by a lot of gold and silver promoters as a reason to own gold and silver. We would argue that it's simply a means of trying to transact more efficiently in the financial markets. And so it's not something that is terribly relevant with where things are at right now.
Thank you. All right, second question. With the conflict between Israel and Hamas, so pretty current news, with erupting this past weekend, could that potentially impact the U.S. markets and portfolios? Laura, please answer that one.
Sure. Obviously, what's happening in the Middle East is devastating, and our as a firm, I think I speak for everyone in our hearts and prayers are for with those people. We've seen geopolitical events happen often, and big question every time they happen is what did we expect to happen in the United States markets? I did a little bit of research on this morning, actually, just to see what has been the average effect on the S&P 500 given geopolitical events going all the way back to Pearl Harbor. So going all the way back to 1941. The average drawdown in the United States market, so in the S&P 500, has been 4.7%. The average time to reach the bottom of the market has been 19 days, and the average time to fully recover has been 42 days. So again, that's almost 23 to 25 different geopolitical events going all the way back to 1941. If we look at some of the more US centered, like 9/11 as an example, the single largest date or the single largest drawdown on 9/11 was about 4.9%. It ended up being an 11.6% drawdown over 11 days that took 31 days to recover. So I think that when these types of wars happen, when these incidents happen, one of the biggest questions is usually, are we going to get involved? Is the United States going to get involved in any capacity, whether that's sending troops to the front line, providing weapons, providing intelligence, whatever it might be, and how does it affect us here at home? And I think it's pretty safe to say that although these events can cause very, very short-term volatility, it also doesn't significantly affect the U.S. markets on the downside, especially not over a long period of time. And so it's something that obviously as investment managers, we keep a very close eye on. We are very on top of what's happening, but it's not expected to significantly affect the markets. And the market yesterday was up 0.3%, and so far the S&P is up 0.7% so far in the day. So it doesn't look like it's affecting us at this point.
All right, thank you. Next question. What will be the impact of the strength of the dollar or exchange rates if some countries exit the dollar as the world's currency and reduce their US dollar reserves? Who would like to take that one?
I can take it. So it's a simple law of supply and demand. The more demand there is for something, the stronger that it ultimately is. And so as the US dollar does become less dominant, we do expect that it will weaken the currency. Now, that may not have the effect, though, that people expect. I would actually argue probably one of the most direct effects is going to be the fact that the US government will not be able to lend out, will not be able to auction off US government bonds at such low rates. And I think we're already seeing that to some extent right now. We've begun to see, even without the Federal Reserve increasing interest rates, we have seen the interest rate on government treasuries go up fairly considerably over the last 3 or 4 months. And so I think as you start to see more of the international community use it less, specifically the enemies of the US or countries that are more likely to go into conflict, I think that'll put the U.S. in a position where they have to pay a higher interest rate for their debt than they would have, say, a year and a half or 2 years ago.
Okay. Next question. Why is the peso so strong, having increased in value by 20% against the dollar since the spring of 2020? Who'd like to take that one?
I can't speak to that one. I haven't researched the peso and don't have a deep knowledge of their foreign currencies. I don't think Max or Laura do either. If they do, they can chime in.
Okay. All right. Next question. You mentioned that the EU would not be a good alternative. Can you expound on that? Josh.
Yeah, so the European Union is probably what a lot of people would say, well, why wouldn't the euro potentially, because it's a fairly strong currency, why couldn't it be considered a world reserve currency? Fundamentally, the first problem is the EU is what many economists would argue is a failed experiment, where you basically have 26 plus countries that have chosen to use the same currency, but they don't have the same government governing over all of them. They have individual governments with individual fiscal policies, and they've all agreed to stay within they can't have debt above a certain level. But guess what? They don't abide by it. And that's resulted already in 3 or 4 instances over the last 5 or 6 years where the euro was quite close to potentially shattering as a currency, or at least at the very minimum, starting to see countries leave on a regular basis. Most of the world at this point would consider the European Union as an idea a failed experiment, at least related to the currency side. Many people believe over the next decade to decade and a half that you will see more and more countries leave the European Union and it will become less dominant. Obviously, we've already seen this with Brexit. Britain did not want to be on the hook for countries like Greece, Portugal, Spain, Iceland, who would not exercise fiscal discipline and then would have to be bailed out. And so many people argue that once the German people have lost their desire to bail out other countries, that we will begin to see more and more problems with the euro. So that reason by itself is one of the major reasons we don't believe it will likely be the world's reserve currency. There's a large number of other ones we could talk about as well.
All right. Well, those are all the questions and just about out of time. So thank you for our panelists. And just want to say, really enjoyed the conversation. Everyone have a great weekend or a great week and look forward to seeing you at the next Beyond the Noise.